Hey everyone, welcome in to another daily editorial here on the KE Report. Corey and Shad chatting with Jordan Roy-Byrne, founder and editor of The Daily Gold. Now, Jordan, it's a Fed day, so look, I think we all just need to wait to see what the Fed says in their statement, what Powell says in his press conference, and even more so when it comes to market reaction, where the markets are about a day and a half to 2 days out, because we always get that volatility and we seem to get almost fake out moves on the back of these days and even the following day. Let's take a little step back then and talk, I guess, bigger picture on gold. Gold is continuing to just hang around this $2,000 level. It was below it, I think, last week, has moved above it fairly nicely at 2,000, about 33 right now as we're recording. Silver also hanging out above that $25 level. Look, there's still a lot of people on one side saying a breakout's coming and look out. This breakout could take us to 2,400. And then there's also the other side that says, well, a correction could be coming, especially if the dollar bounces, especially if yields bounce back. Jordan, on the correction front, what are you watching for? What is the potential here of a correction in the precious metals?
Well, I think the potential for a correction, or at least more of a correction, is definitely there because we are in a correction for the precious metal sector. It's only been, I don't know, 13 or 14 days, but they've held up really well so far. Looking at gold, for example, has been holding above 1980. Silver's been holding above 2450. So you really have to like the action here. And I think if they can hold above those support levels for another week or so, or if they get another hard test here after the Fed, then I think you could have the makings of a bull flag pattern in this correction. So that's something I'm thinking about. At the same time, looking at the dollar and the daily chart, it has started to stabilize a little bit, or at least in April. And it's definitely possible the dollar could rally a bit higher from here. It could rally a couple points or maybe more than that. And if you get that, that would certainly extend the correction in precious metals or potentially push gold and silver below those aforementioned support levels. Gold specifically at 1980. I wouldn't really worry about it for gold. It has support at 1980, but also 1950 and 1900. And these are pretty minimal. I mean, it would be a pretty minimal correction overall, even if you get that bounce in the dollar compared to gold's corrections. I mean, we're looking at history and what it does early in a new bull market. The corrections don't tend to be that great in terms of the percentage decline, unless the market has really gotten overbought. There's had a huge move in percentage terms, which gold doesn't fit those two parameters yet. And I mean, looking at the stocks, I mean, the miners, they've held up pretty well. Looking at, my breadth readings, even coming into this week, you still had, I think, over 85% of GDXJ and Huey stocks are above the 50-day moving averages. So everything's been holding up pretty well so far, but just looking carefully at the price action, the sector needs either more time or more of a price decline before I think it could get in position to make another move to new all-time highs with respect to the gold price.
Yeah, Jordan. So maybe just a little more consolidation and base building to build the energy to be able to make a move up higher to a breakout price. You made an interesting point there, and we've discussed this in previous episodes with you, that in a new bull market, the pullbacks are more shallow and not as extreme as people have been used to when we've been in the bear market pattern. So maybe just let's talk a little bit big picture for investors, switching from a bear market playbook to a bull market playbook. I guess number one, what gives you the confidence we are in a new bull market? And number two, how would you be looking at this from a more medium to longer term? Because not everybody's going to trade every little blip and bounce and pullback, but just what would your bull market playbook be for investors for the longer to medium term?
Well, on the first question, I would say, what gives me the confidence this is a new bull market? I would say the price action in gold, in that it's extremely close to breaking above 2050 or 2070 or whatever support level you want to use. I mean, gold, after the sharp decline last year, then it had the false breakdown below 1675. Now it's made 2 monthly closes at new all-time highs. It made a quarterly close at a new all-time high. On the weekly chart, it was less than $1 away from making a new weekly all-time high. A lot of the if you're looking at the top 5 weekly closes all time for gold, I think 4 of those have been, in the top 5, other than the all-time high itself. Gold against foreign currencies has made a new all-time high. Gold against the stock market looks pretty good, although it's correcting now. I think the next move above resistance will be significant. So looking at all these things and then aligning them with the fact that, the stock market has been in this bear market, you have that, which is a critical aspect. And gold's also outperforming everything else. So if you look at what's going on in terms of macro and then also on the charts, it aligns with a new bull market. But that being said, gold really needs to make that close above 2100 to give us full confirmation. Now, in terms of, how does the playbook change? Well, one thing I'm looking at in terms of these corrections is early in a new bull market, gold typically corrects down to either the 50-day, 100-day, or 150-day. If it's more of a significant, like a 10, 12% type correction, it's really overbought, then it might come back to the 150-day. Otherwise, and this is the case right now, at least I believe, we're looking at the 50 or 100-day as support. So that's something I look at the beginning of a new bull market. In terms of how the playbook changes, you have to understand that we're not going to see just huge corrections in percentage terms unless the gold market gets really overbought and really stretched. And so looking at where we are here and now, gold is really close to making this hugely significant breakout, but it definitely could correct for, a couple more weeks or even a couple more months here. And, but I think the key is after it makes that breakout, there's potential because you're in a new bull market. You're in a really significant breakout from the super bullish cup and handle pattern, multi-decade resistance, et cetera. In that scenario, after that breakout, the market could get really overbought and it could also stay really overbought. So that's a major thing as far as how the playbook could really change. I mean, in terms of looking at stocks, I'm not quite ready yet to say, oh, this is a time for full optionality, or, we should be making really aggressive leverage bets that, the prices are about to move much, much higher. So I think that's something to keep in mind. I'm still focusing mostly on quality here, but again, assuming gold makes that breakout, you have to expect that it's going to stay really overbought in that breakout move, given the upside targets of 3,000 and then 4,000. Then at the same time, after it makes that breakout, you have to evaluate silver's potential to really break above 30, because typically, gold makes the big breakout first, then silver follows. So that's also how the playbook could change. After the gold breakout, I would be more keen on silver and probably more bullish on silver. I don't know if that's going to be at 2,300, 2,400, or, immediately after the gold breakout, but we'll see. But at least those are the things that I'm thinking about. I don't think the playbook changes that much, but I would definitely say you can be, I like to be a buy and hold investor, and that's obviously been difficult in the last couple of years, but I think you can be more of a buy and hold investor, going into this breakout. You might be able to hold for a couple years, which again, that's been really rare in this sector. So those are potentially, I think, some differences as far as how your perspective should change over the coming months, versus being in the last couple years where the market was in this cyclical bear market.
Jordan, can I get you to elaborate a little bit on that comment on those optionality plays? Because it is interesting and something to note, right? That these optionality plays, they've been moving a little bit, but again, we're not in that environment where everything's moving higher, and this is with gold above 2,000. So look, it just goes to show that we don't have everybody rushing into the sector, but again, it's a market of have and haves nots right now. What does it take to get those optionality plays going? Is it that gold breakout that you referred to? Is it that silver up above $30? Or is it something else, another market breaking down that draws more money broadly into some of these optionality plays, which there are a lot of?
Yeah, I think it's just the price levels, honestly. I mean, looking at gold, I think earlier in this interview, we were talking about the significance of the $2,000 level. I think it's really 2,100 because if you're looking at the gold chart, if you're looking at a 4 or 5 year chart, you can see this clear resistance at 2,100. So yes, it's a really good sign that gold has rallied back to 2050, and it's so far it's correcting bullishly because that tells us this market is in position to make that huge breakout. If it petered out at 1900 or 1950, you could still make more of a bearish case, but you really can't now looking at it technically. But again, circling back, 2100 is the key level. You can tell looking at the chart because you get above 2100, the next 2, 3, $400 are going to come that much easier. So I think I agree with what you're positing there in your question that gold has to break above 2100 for these optionality plays to really start to receive capital inflows. Same thing with silver breaking above 30. Maybe for silver it's when it starts to break above 28. But if you're looking at gold, I mean, if you think about it, think about the margins on, let's just say, the all-in cost of, it's an optionality play. The all-in cost is 14 or 1500, and you're looking at, gold's been bouncing around at, it rallied up to 1950, pulled back, 2050. Now it's consolidated. It's not a huge difference for, if you have a project where the all-in cost is 14 or 1500. I mean, your margin is bouncing around from 400, 350, 425. It's not a huge difference, but you break above 2100 and you're looking at 22, 2300, then suddenly your margin is, $600, $700, $800 an ounce within a couple months. And, costs are not skyrocketing in that time. So that's why breaking above 2100 is so significant for the industry, because even on the optionality plays and those lower quality projects, the margins on those things are really going to explode. And same thing with silver. I think if silver is able to surpass that 28 to 30 level, much more capital is going to be coming into the sector, and it's the same thing. So I think it really comes down to just breaking those resistance levels.
Yeah, great point, Jordan. Again, every time we've seen a big rally in the sector, it's sometimes the more marginal producers or the development projects that have higher input costs that have the biggest percentage gains on a margin basis, because some of the best run companies already have pretty fat margins here. But when you go from a crappy margin to an okay margin, or from underwater to above water, suddenly that re-rates that company. And that's when those optionality plays really take off with the margin expansion. But you mentioned you've been focused more on quality, and I know you're not going to name names because you keep those for your subscribers, but can you just tell us the kind of companies that you've got in your portfolio right now, Jordan, to ride the coming bull market?
I can't recall if I said this last time or if it was a couple weeks ago, but I'm focused on junior producers. I mean, I do have a couple kind of advanced exploration plays that I think are going to be taken out. One I think is definitely is kind of a strong word. I think one is very likely to be acquired this year at a higher price. And, I do own another company, which I think will be taken out in the next couple years. But aside from those two, I'm really focused on, in the gold space, I do have one exploration play, but I would say junior producers, just because the outcomes are more predictable. And, if you have a junior producer that has production growth potential over the next 2 or 3 years, that looks like it could be lining up with a major bull market in the sector. And so growth-oriented producers those are really the companies that you want to own, because, I mean, they're not, everything can be a leverage play in some sense, but the leverage is magnified when their production has potential to increase significantly. So I'm greatly focused on that. In addition to, I'm going to try and see if I can find more exploration plays. I mean, I think in recent years, even the last 4 or 5 years, I've really struggled. My investments in those have not fared as well. I mean, a large part is, because we haven't been in a real bull market. But that's, if you can find those small explorers that really have a chance to, say, find or grow to a 3 million ounce plus project at good margins, I think you can make huge gains in those. Also on the silver side, I mean, in a bull market, silver does so much better than gold. So I think you can be a little more flexible in looking at silver stocks. I mean, if there's producers there you like, and I mean, I even like some of the optionality plays, but I'm really picky, and obviously looking to explorers in silver as well. So, silver, I'm more flexible, but with respect to gold, I'm really mostly focused on junior producers, and in both cases, I'm avoiding I want to say developers that they aren't going to build the mine, or they're like 3 years away from production, or they're going to have trouble raising the money. I mean, yes, those stocks are going to be very leveraged to metals prices, but I'm trying to find things that I think can make the absolute best gains here without scraping the bottom of the barrel. And I just think that these big development plays that are kind of optionality plays, especially in gold, I just don't think you're going to make more than like a 3 or 4 or 5x in those. I mean, it sounds really greedy. I just think there's much better opportunities in certain exploration plays and the growth oriented producers.
All right. Well, I guess to find those out, you have to subscribe to Jordan's newsletter. But Jordan, hey, thank you for this update. Look, we can talk all we want about where the market's going to go and what the Fed's going to do, but only time will tell. And right now, there's no denying that markets and even gold are looking good. So yes, that can always change, but they've been looking good for a while here, and they continue to hold out at these very close to all-time high levels. Thanks again for your time, Jordan. We'll chat next week. Have a great rest of your week.